Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report so dense it could probably sink a ship or at least confuse your accountant. We're looking at Mifflinburg Bancorp and it's got some interesting twists. This small Pennsylvania bank is about to merge with another bank, Northumberland Bancorp. The big news, it's an all-stock deal worth about $34 million. So what does this mean for the future of Mifflinburg? Let's decode. First, let's get something straight. This report is a special financial statement filed because of the upcoming merger. They needed to show their financial health before the deal goes through. So think of this report as a pre-wedding checkup. Now for the good stuff, according to the report from their accounting firm Yount, Hardin Barber, the financial statements of Mifflinburg Bancorp are presented fairly and in all material respects in conformity with accounting principles generally accepted in the United States of America. Basically, everything looks good. Looking at the balance sheet, Mifflinburg's total assets are up from $560.6 million to $596 million more in total assets than they previously did. But here's a twist. Their cash has actually dropped from about $10 million to $455 million. In the same year, their loans grew by almost $50 million. Let's move to the income statement, which shows how much money the company made. The amount of money they made from interest and fees on loans increased from about $18.5 million to $22.4 million. So they're making more money from their loans. But it cost money to make money, and their interest expense also rose from about $7.5 million to $9.8 million, meaning they spent more on interest than they previously did. Here's where it gets interesting. They actually had to set aside $680,000 for credit losses, which is the money they expect to lose on loans that won't be paid back. Last year, they were actually able to recover some money from previous losses, so it was a credit instead. Keep that in mind as it becomes important later. Their expenses are also up, with salaries, data processing, and even merger expenses all costing them more. At the very bottom line, however, they still ended up with $4.5 million in profit, about $300,000 more than previous year. Now let's dig into the cash flow statement. This tells us where the company's cash came from and where it went. While they made $40, it appears they invested in loaning activities, with investments in debt securities going down by $7.9 million and investments in loans going up by over $48 million. A very material amount. Their deposits also grew nicely, with a positive cash flow of about $31.4 million. Let's see what is going on with their investment strategy. There appears to be a lot of bonds that are not doing too well. This report shows over $5 million in unrealized losses. The fair value of US government securities have plummeted almost $500,000. That's a notable impact and a good thing for them to try to resolve. Checking out the loan portfolio, most of the loans are pass class loans, meaning loans to customers with credit quality ranging from an acceptable to very high quality. But what does that even mean? Basically, they rate their loan quality in different grades to estimate the risk that a client won't be able to pay them back. The loans are assessed based upon the information in the loan committee package and a lender identified score. Good practice on their part to ensure the loan portfolio is doing well. They also had to make changes to the amount they estimate it would cost the company with the retirement of ESOP employees. Not a big factor on the report, but something that changed. These commitments include standby letters of credit and other instruments which require collateral as necessary and which require monitoring with credit policies. There are some changes in account regulations, but they do not expect the adoption of ASU 2024-09 to have a material impact on its consolidated financial statements or other various statements, so the big picture is the same for Mifflinburg. This is a pretty dense set of numbers about their unrealized losses from debt security investments, so unless you're an accounting wizard, just know that a lot of their investments aren't worth as much as they thought they were. Management also talks about mortgage banking, which is the mortgage loans originated and intended for sale in the secondary market at the time of origination, are carried at the lower of aggregate cost or estimated fair value as determined by aggregate outstanding commitments from investors or current investor yield requirements. Okay, so after digging through this filing, what's the story? Mifflinburg is a small bank in Pennsylvania that's about to get a little bigger through a merger. They're making more money from loans, but their expenses are up and some of their investments aren't doing so hot. What it all means for Mifflinburg. Here's my take. Mifflinburg is in a transition period. This merger is their big move for growth. and they are going to change their names, which should be interesting. While profits are decent, keep an eye on those expenses and losses from their investments. The combination likely results in a higher valuation in subsequent periods. The loan portfolio, while growing, it may be a risk with growing interest rates. Overall, Mifflinburg is trying to adapt to a changing financial landscape. The next couple of years will be crucial to make sure that the changes from the merger is an overall positive change. Thanks for watching. If you enjoyed this video, please like, comment and subscribe for more deep dives into the world of corporate filings.